Welcome, everybody. My name is Jeff Amerine. I'm the managing director and founder of the Startup Junkie, and we work closely with our partners, the Conductor. Welcome to our digital library. During the course of many different episodes that we're going to feature, you're going to learn about Lean Canvas, how to run a startup, how to build a startup, customer discovery, and a variety of other topics. Welcome. We hope you enjoy it. Hey everybody, today we're going to talk a little bit about early stage investing, and I'm going to give it to you from two perspectives: an active early stage investor that has run several funds and an entrepreneur. So in my own case, I've been involved with 9 different startups in terms of creating teams and getting them funded and getting them to market, and I've also made more than 90 early stage investments. So I'll give you the perspective from both sides of the table. First of all, we'll start talking a little bit about angel investing statistics, and then we'll talk a little bit about how an investor will evaluate the quality of investment. We'll talk some about where to find a qualified deal flow. We'll give you a little bit of try to decode some of the mystery around the language and the jargon that's used. And I may talk a little bit about case studies, sort of the good, the bad, and the ugly of early stage investing and what's happened with various companies along the way. Out of this, you should get a little bit of an understanding of what investors think about and also how to think about it from an entrepreneurial standpoint. So there's a lot of mythology, and a lot of people get captivated with the idea that they're going to start a new venture and they're going to run out and raise venture capital. To be clear, not very many companies are successful in raising venture capital. It's a very, very small percentage, and yet a lot of great companies are built without having to take outside capital at all. So keep that in mind. This is a very, very small group of all small businesses that actually are successful in pursuing it. But angel investors, and an angel investor is defined as a high net worth individual that will either invest directly or invest through an angel fund in a business, typically at seed or early stage. They invest in the U.S. $24 billion annually in 64,000 ventures. 55% of angels are former founders or startup CEOs. So think about that. The reason why that is those of us who have walked that path understand the process that an entrepreneur is going through. Only 22% of angels are women, which is unfortunate. We need greater representation there. The average angel investor check size is $25,000. 62% of all American angels, interestingly enough, are not in Silicon Valley, New York, or Boston. They're everywhere else. 89% of all angels find deal flow through angel groups, through angel forums, or angel funds. And the target investment return per deal that most people look for is 9 times their initial money, or 10 is kind of the metric you think about. And as you think about that, it's super high risk. So if I'm an angel investor and I'm going to make 10 investments, I know that 3 or 4 of those might be absolute zeros and not return anything. 3 or 4 or 5 of those might be okay. Maybe they return the initial money at some point in the future, 7 to 10 years down the road. 1 or 2 are going to be 10 times returns on money or maybe more. And I've experienced every aspect of that in my own investment activity. So think about that. I'll also say that seed and angel investments in U.S. and Canadian companies, the year-over-year change, it tends to vary a little bit. When the economy, the public markets are down, actually angel investment tends to increase, interestingly enough. So just to go through some of the other things that are really important in that regard is there have been a lot of companies that have raised money locally, angel stage and venture stage. And what would an investor typically look for in that instance? They're looking first and foremost, and maybe it's the top 3 things, for the quality of the team. It's not necessarily important that the team has done exactly the same thing multiple times before, but does the team have the passion, the energy, the knowledge, the grit, the tenacity to be successful? So investors are first and foremost evaluating the quality of the team. The next thing we look for is there a competitive advantage here? Is there a way to build an economic moat around this that's going to be interesting? As an investor, sometimes we're going to look at the sector and the stage. Is it in an industry where I can help move the needle on the business because I have contacts or access or unique knowledge? What stage of the business is it? Are they already generating revenues? Are they pre-revenue, etc.? The market opportunity. Most early stage investors want to invest in things that have at least $1 billion market opportunity. Otherwise, the market opportunity is so small that the probability of an acquisition or some kind of exit, which is the way we get our return, is very low. What's the valuation? So how much is that business worth? How are they valuing themselves? What deal structure are they using? Is it a priced round where they've got preferred shares? Are they selling founder shares, common shares? Are they using a simple agreement for equity later called a SAFE? Are they using a convertible note? So that's key. And then aligned interests is really important. Some people want to build a business that they're going to have for the rest of their life and pass on to their kids. Most early stage investors are interested in investing in things where there's some kind of an exit. A larger company comes along, a private equity business comes along, a fund comes along and buys that company out, and that's when I get my return. It's the difference between capital appreciation as something becomes more valuable versus at some point I might get distributions or dividends. It's a different mindset. So understanding how to align those is really important. And you got to understand, too, that there's a difference in point of view. So the investors will typically go into a potential investment looking at all the things I just described, and they're thinking about what could go wrong. So what's the risk? What's the potential return? They have their own stakeholders. If it's a fund, they have their own limited partners that are holding them to a specific investment thesis and expected return. They've got compliance issues. On the entrepreneur side, they're thinking about, I need to raise the seed round or this A round because I need this much run rate so I can achieve these things. I'm trying to build something that will change the world. There's meaning that I'm trying to create. So they're constantly thinking about runway and growth. And a lot of times that point of view on valuation is at significant odds. The entrepreneurs will think the value's up here. The investors, based on their experience, will think it's down there. And through some unique deal structures, particularly for early stage, like convertible notes and simple agreements for later, you can put off that valuation discussion by doing something other than having a priced sale of shares. So there's unique points of view that can be reconciled there. And when you look at the anatomy of a capital raise, as an entrepreneur, I'm looking to think about, I'm thinking sales and key hires, and these are what I need capital needs for, and building the brand and advancing the product. On the other side, in the due diligence that the investor does, they're thinking about team and burn rate and how much traction do they have and what confidence do I have in their ability to raise money after they raise money from me at some point in the future. And are they able to sell? It's a big component. So again, kind of like we've talked about in risk management, the due diligence includes a really deep dive around all the corporate documentation. There's typically a checklist and a report that's generated. It could take 30 to 90 days to complete, but they're looking at the team, the finance, the financial wherewithal of the business, the product and the technology hurdles, the market and the customer, and then any other intangible categories of risk. There's some really great books that break this down in a way that you can understand it. One was written by Brad Feld, who's the guy that's been sort of one of the founders of Techstars. He sits in Boulder. It's called Venture Deals. It gives a really good description so that before you engage your venture attorney or you talk to your accountants or whoever else, you know what all this jargon means. You understand term sheets and how deals work and protective provisions and economics and all that sort of stuff. And then there's another one that's written that's called The Business of Venture Capital, and it gives you some insight into why funds, larger funds, venture capital funds, act the way they act. I'd recommend it if you're interested in this space. So what are some of the typical deal structures we see? Sometimes you'll see a priced round with preferred equity. Well, what do we mean by that? That means there's a preference on that share, and that preference is that as the investor, I get paid out first before you do as a founder, a common shareholder. There may be other issues associated with that, as that when it converts to common shares, it might convert at some kind of preferential ratio, or I might have a coupon, an interest rate attached to it. Preferred equity sits in between debt and creditor obligations and common founder shares. A convertible note is this sort of interesting hybrid that says, we're going to give you this debt instrument, this is like a loan, and there's going to typically be an interest rate associated with it, and it might run for a couple of years, and you're not actually paying out the interest, but that interest accumulates and then converts at the time that you've raised another round of money. And at that point, it's also got either a discount rate or a cap, so that my risk premium as an investor is captured by virtue of the fact that I'm paying less for shares than the folks that came next. What came out of Silicon Valley within the last few years is called a simple agreement for equity later. Very simple, short, couple-page agreement. It puts off that discussion of valuation to some point in the future. It's easy to manifest. It's like a convertible note, but there's typically no interest rate associated with it. So preferred equity, what is that? That's really just a purchase of shares or membership units. The problem is it typically requires a defined valuation that people can agree to and a share price. There'll be a share purchase agreement with terms. The advantage is it gives clarity to the investor. As an investor, you know exactly what you have. The main advantage, or the main challenge, I should say, is it's difficult to value early stage ventures that don't have a lot of revenue or a lot of history. Convertible note, we talked about that. It's a promissory note. Typically includes simple interest. It has a defined term. It includes a discount rate. It may include a valuation cap, so the valuation can be no higher than a certain amount. It will have qualifying equity raise, so in order for it to convert, you have to raise a certain amount of money within a certain amount of time. The main challenge with this one is that there's potential taxable income for the investor, even though they're not receiving any income. In the eyes of the IRS, you've got this accumulating interest all the way along. And then a SAFE is essentially the same thing as a convertible note. It's just shorter and simpler and has no interest rate associated with it. The challenge there is there's not a lot of precedent for it. People may not understand where that fits if there's ever a legal challenge. So what can you do to engage as an investor? You can join an angel forum like the Central Arkansas Angel Network that's just forming. You can go on these national sites like AngelList and Gust. You can invest in an angel fund or a venture fund. We have some locally like Cadron Capital Partners and New Road Capital Partners. These are all ways to engage that as an angel investor or an early stage investor will protect you from investing in things that you don't understand or by yourself, rather than having these groups of people that can rally around a given investment. As an entrepreneur, the more you understand about the mindset of the investor, the better job you can do in developing a presentation that will speak to their needs and engaging them in a way that they might actually write you a check.